All right, so now we're going to illustrate the other method for preparing the operating activities section of the cash flow statement, and that is the indirect method. The indirect method is preferred by businesses for a couple of reasons. One is one of the objectives of the cash flow statement is to reconcile net income from the income statement to cash flows from operations. And this statement very clearly demonstrates that reconciliation. It clearly explains why income is different from cash flows from operations. The second reason, remember in the last video I told you that if the direct method is used, then a supplementary schedule, which is reconciling income to cash flows from operations, is required. So in other words, businesses that choose to use the direct method have to prepare the cash flows from operating activities section twice. That costs money. So just going ahead and doing the indirect method is preferable because it saves time and saves money. International corporations, though, have to use the direct method because international financial accounting standards require the direct method. All right, so let's look at what the indirect method looks like. All right, the indirect method starts with net income because we are reconciling net income to cash flows from operations. So going back to our data sheet, we see that net income for this particular year was actually a net operating loss. So I need to change my label over here instead of net income to be in parentheses net loss, because a negative is a loss. So that was $34,000 net loss in the current year. And then we've got two types of adjustments. We've got adjustments for non-cash expenses, or it could be non-cash revenues, and non-operating or those unusual or infrequent gains and losses. So non-cash items, one is depreciation expense. So we're going to add depreciation expense. And also, if we had amortization expense, amortization of intangible assets, or depletion expense, none of those require cash. So we would add back those items as well. Now, the depreciation expense on my income statement was $35,000. And remember, this setup is a little different from what your template that I put on Canvas looks like because I added the depreciation expense separately to emphasize how it is treated. So the depreciation expense is $35,000, so we're going to add it back because it does not require the use of cash. The other type of adjustment is we would add back non-operating losses, like if we sold a piece of equipment at a loss, we'd add back that loss, or we would subtract out gains. If we sold land at a gain, we would subtract out that gain. Now, the reason for this is that the cash from those transactions is going to be shown in the investing activity section. Cash received from the sale of land will be shown in investing. Cash received from the sale of equipment will be shown in investing activities. So we don't want the gain or loss that's a part of that sale to be double counted. So we adjust net income to take out the gain or loss so that we can focus on the cash flows in the section where it's supposed to be. So again, let's look back at our income statement. And we had a loss on the sale of marketable securities. Now, when we buy those marketable securities, that is an investing activity. So when we sell them, the loss on the sale of those is also an investing activity. So we need to add back that loss on the sale of those marketable securities. And again, there may be many of these types of adjustments. So non-cash items like depreciation and amortization and non-operating gains or losses that are a part of net income are adjusted out of net income in moving towards cash from operating activities. Then we adjust, I'm going to bold these so the headings will stand out apart from the items. Then we adjust for changes in current assets and current liabilities. Now these changes are a little bit different from what we saw under the direct method. So to adjust for changes in current assets and current liabilities. And to me, remembering these adjustments is so much easier than remembering all the individual adjustments to the individual revenue and expense items. If we had an increase in a current asset, we'll subtract it. So you always subtract any increases in a current asset, with the exception of marketable securities because they're investments. They're accounted for in the investing activities. And we would add a decrease in current assets, any current asset. So we go the opposite direction, kind of like what we did with adjusting revenue. We subtract, well, for current liabilities, we add an increase in current liabilities, and we subtract a decrease in current liabilities. So with the current liabilities, the adjustment is always in the same direction as the change in the account. So if you can remember, that's just 4 things to remember. Subtract an increase in current assets, so add a decrease in current assets, add an increase in current liabilities, and subtract a decrease in current liabilities. Again, to me, a whole lot easier to remember. So we go back to our comparative balance sheet, and again, remember, we don't include cash. And marketable securities, we said, were investing activities. So that's the cash flow from that's going to be elsewhere. So we cut down to accounts receivable. Accounts receivable decreased by $17,000. So if accounts receivable decreased, we're going to add that. Excuse me. And next item, inventory. Inventory increased by $2,000. So under the indirect method, we will subtract the increase in inventory of $2,000. And again, positives and negatives matter. If it's subtracted, show it as a negative. If it's added, show it as a positive. All right, back to our balance sheet. The next item is plant and equipment. They're accounted for in investing activities, and we've already accounted for the depreciation, so we keep moving down. Next, in liabilities, we've got accounts payable, which increased by $23,000. So an increase in a current liability is added. So we'll add that increase in accounts payable. That was $23,000. And then the next item is accrued expenses payable. That was a decrease of $3,000. And we subtract decreases in current liabilities. So that's a minus $3,000. And let me make sure I didn't mess up the amounts on that. Yep, so far so good. And then the next item on the comparative balance sheet is notes payable. And remember we said when we issue a note, it's usually because, well, we're borrowing money to buy a car or we're borrowing money to buy equipment. So that is going to be treated, that's a borrowing transaction with a creditor as opposed to just on account kind of purchase. So that's going to go in financing activities. So will the capital stock changes. So that's it. That's all of our adjustments to net income. So just like with the direct method, our next step is to sum all of these items, pluses and minuses, and I'm going to enter a formula in here to do that math for me rather than pulling out my calculator. That's the beauty of spreadsheets. And notice as I enter the formula, what I'm going to be adding, what I'm going to be summing is highlighted there. So I make sure I've got everything in that formula, and I do. And my net cash, it's positive, so it's cash provided by operating activities is $37,000. And notice that is exactly the same net cash provided by operating activities that we got under the direct method. So some of your homework assignments will ask you to do it both ways. If they don't equal, you got a mistake in your logic somewhere, or your math, or both. All right, so that is the indirect method. And like I said, to me, I got to learn 4 adjustments or 4 changes for the current assets and current liabilities and what to do with them. And I've got to remember non-cash items like depreciation, non-operating gains or losses are adjusted for. So that's only 6 things I've really got to remember. So it's much easier for me to do the indirect method than to do the direct method. All right, so next we'll take a look at investing and financing activities.